All right, guys, it's Friday, last day of the week, June 14th, highlight of the day. First of all, happy Father's Day to all the fathers out there. Forget to say it, which is this Sunday. This just happened as far as doing this live. On the lows, rejection. The metaphor I use is how do you know for sure or a high probability that price was rejected? Well, how do you know at a high probability that when you were single and you were at the bar that the girl wasn't going to give you her phone number? Well, if she slaps you in the face, that's rejection. You know pretty clear you're not going to get her number. Well, where's that slap in the face moment in a low, on a high? I'm going to play this back at real speed at 84.50. We had some aggressive buying and selling come in. Here's some selling at 84.75. Initially, she was in a little bit of trouble on the sell side, but then it comes right back after it, and he comes in buying 84.75. Let's see if I could share the computer sound on the audio. The green and the red down here in the lower right. Now, I was wrong before I was right. Now, here's what I mean by that. Let me pause it. See where it's green, 84.75, which means when it goes 84.75 offer, quickly people aggressively try to come up and buy it. So to me, they're in trouble below there. And generally they are. And generally I say one tick below their 84 halves, it goes offer, look out below. And that's exactly what I said in real time. It went 84 half offer and quickly went bid, which means it went up 3 ticks. And I said, all bets are off. I'm dead wrong right there. Had I been short, I'd have puked it for a quick loser. Had I been bullish, I would have been playing it from the long side or just got long. It's just a higher probability that that's rejection. Now watch it. Not just because it jumped out of the hole like that, but because it had everything lined up to actually go down. Some stuck buying, and it should have went down with quotes around the word should, and then it doesn't. So watch this. It goes quickly 84 half offer, and you know that by both sides of the footprint trading, and goes bid. 84.75 bid, 85 even bid, 85 quarter bid. And then if I pause it and speed this up just a little bit, you could see the continuation. You could see some selling getting stuck there and a long up bar and the eventual continuation all the way to where we're at now, 91.92. One thing I want to make sure people know is that today's rollover. So this is the SEP contract. If the prices look different, I roll on Fridays when the SEP or the next contract volume takes over the previous one, which is essentially not Thursday, it's Friday. But you see, it's like down in here in real time, I said dead wrong thinking it was going to go lower. 3 or 4 ticks after the rejection, not 3 or 4 points later. That's a really important highlight, because it's not just how it comes out of the hole like that. It's that it really should have went down and had some continuation and extended the rally. So if it doesn't get you on the right side, it should keep you off the wrong side. And I know a lot of people when they start trading or they get into trading, they look at a chart and they want to be able to get long the big rally, get short the big sell off. The first thing is to stay off the wrong side. And I know that doesn't have a lot of sex appeal, but you want to stay off the wrong side before you hope to get on the right side. You want to manage your risk before you realize reward. A lot of people aren't good at that because they don't know what risk is. They don't measure it. They don't know how to manage it. So they'll let like a week worth of profits gone in 1 or 2 trades. Even 1 or 2 trades could take away a whole week. Then you know you're just getting lucky and it's random. You can't let 2 months of profit gone in a week, gone in a day. I think that happens to a lot of people because what they're doing is kind of random, or what they're doing is good, but they don't adjust to the market adjusting. So the market changes, and what your style was conducive to one type of market, the market changed, and your style no longer is conducive to the rotational sense that the market might start trading, and you didn't adjust with it. So you got to think of yourself as a branch that bends on windy days and doesn't break. You have to adjust. One thing I always say is you're looking at something in these markets, whether you look at a dome, look at a chart, look at a footprint, you're looking at something that's constantly changing and adjusting to different conditions and variables. So if you're not able to adjust a little bit with it, then you're too you're opposite of what you're trying to be involved with. You got to be flexible. You can't be too flexible. Your head spins. Like that movie, The Exorcist. Your head starts to spinning if you're too bullish, too bearish in the same 10 seconds. But you can't just be stubbornly bullish, stubbornly bearish because your profile told you that. One thing I always, when I bring up profile, I think it's a great tool to learn to understand, but understand the weakness of profiling. Profiling gives you a good opinion, doesn't give you a good price to execute that opinion. So you're going to have to overlap some skill set with your profile skill set, because knowing when to execute will always be more important, or the most important thing about trading. Where price is going is important, but less important than when price is going. Happy Father's Day. We'll see everybody on Monday.